You once described your investment philosophy as understanding big revolutionary themes in the markets and focusing on taking advantage of structural opportunities created by these changes.
That's true.
So what are you doing? Where do you see change and how are you taking advantage of it?
So the biggest change going on in our space, which is the financial space, is small banks, medium banks, United States, which is both in the equity side and in the debt side. And there is literally a revolution taking place where they're getting the advantage of a massive pendulum swing towards deregulation. The Federal Reserve Board, Congress, and the administration all put in rules that favor small banks so that the playing field is not level. They have huge advantages over large banks, therefore they're growing at 8%, plus with mergers they're growing at 12, 15%, and that becomes a positive feedback loop where their stocks, if they have stocks, are doing well, the capital markets are open. LIBOR hit a new high today, right as we're talking, and that is a huge plus for banks because of the way they've structured themselves. And on top of that, we have more gasoline on the fire. We have new regulation coming out of the Senate and probably the House by Memorial Day that favors small banks.
When you say small, we're talking banks with how much capital?
Well, we have a crazy system in the United States where you have one class that is under 1 billion, you have another class that's under 10 billion, another class under 50 billion, you have another class 50 to 250, and then you have above 250. So it's quite a complex system, but they are simplifying the system. I'm talking about mainly banks under 10 billion.
So these are small banks?
Yes, some of them have 3 branches. They're across the street from each other in every small town in America. Remember, this is the only country in the world where there are 5,000 banks all over the place.
It's not often I talk to a hedge fund manager and he says the best opportunity I see is in banking. How big a position do you have in small banks?
So in small banks, with our CDOs, obviously, of our $9.5 billion, it's probably $6.5, $7 billion.
It's an enormous position.
Yes, it is. But remember, a lot of that is the debt of small banks, which is a $30 billion market.
And how much of the potential value that you see in these small banks has been realized already? How much room is there left to run?
Nobody knows, but obviously we're putting more money in because we still think there's substantial room to run. I wouldn't want to put an exact number on it, but it's quite large.
But what about the impact of rising rates, for example, the fact that we've had off and on a flattening yield curve, generally not a good thing for the banking industry?
Sure, so that's past history. That's looking the way it was 20, 30 years ago, where rising rates would scare the hell out of every investor. Instead, because small banks basically have zero costing deposits, rising rates are a plus for them. LIBOR going up is a plus. They're barely affected by the flattening yield curve.
What about the intrusion of private credit? That's a growing industry in the middle market and to some of the borrowers to whom small banks lend.
Sure, so private credit has already had their heyday. It's now under pressure everywhere because remember, private credit came out of the 2009 disaster where Congress basically handcuffed every bank and they couldn't do the loans. In this country, there's 16 trillion of bank debt, bank loans a year. There's 36 trillion of private credit. And now that the banks that have effectively 250 billion of excess capital, they are actually squeezing the middle market. That's why you see middle market credit rate pressure is tremendous. That's why you see BDC after BDC trading at 50% of book because that's where the pressure is. They can't compete with the banks because banks, their cost of deposits is zero.
Manny, what happens if the government, I'm talking about both the administration and the Fed, relax the rules on larger banks? Trump, Mnuchin, and Quarles all want to make it easier for big banks to do business. Isn't it kind of a zero-sum game? The more big banks have, the less small banks have?
There's a little bit of that, but what you're talking about in terms of relaxing the rules are just making little moves at the edge. There is no effort by Congress, no effort by the administration any large size to relax the credit off the big banks. The big banks, the big 10 banks have 75% of the market. They're the evil people in the United States. So there's no political consensus that these banks should get massive relief. And you see even today, barely any relief.
So if
that's
we were to
my least of my fears.
The least of your fears. If we were to take one of these, because you're investing in both public and private banks, if we were to take the generic publicly traded small bank stock that you like, this stock could do what over the next 12, 24 months? Double?
I don't know. I wouldn't say it could double, or we know that it's massively undervalued. Just to give you a feel, you have lots of private banks. You can do deals at $125 a book. You have some banks that are public trading at $130 a book, earning 8%, and they can sell themselves tomorrow morning at 2.25 times book. Run the numbers yourself. That's happening every single day.
We're back to where banks can fetch 2.25.
Some banks trade at 3 times book.